Welcome. This is Tax Pro Nation, the home of the independent tax professionals, where you can find a tax community, maximize your earnings, and live life on your own terms. I'm your host, Imelda Ledesma, COO of Pronto Tax School. In this episode, Daren leads a conversation on how to report general expenses on a Schedule E, covering topics like depreciation, repair regulations, and the distinction between business and residential rental properties.
Good morning, everybody. Welcome to Mastery Mondays here at Pronto Tax School. Good to see everyone this morning. Sorry I was 2 minutes late. I do apologize. Everybody hear me okay? Sounds good?
Yes.
Excellent. Hope everybody's Monday is off to a good start. I had a nice weekend, so that's lovely. And so fired up to be here today. Today we'll be covering expenses on Schedule E. We'll dip into depreciation a little bit because of safe harbor and repair regulations, but I'm going to keep depreciation itself to a separate whole other topic because in the way of we only have 50 minutes on a Monday. So most of these topics on a rental, they offer full day 8-hour seminars on. So I try to cover as much as I possibly can inside of an hour, and especially with rentals, each thing leads to another thing, so trying to keep it as focused as possible. And so today we'll just be going over Schedule E and general expenses. We'll dip a little bit into the depreciation on repair regulations, but all the rest of the depreciation stuff, still working out the schedule, but I think it may be next Monday we'll cover depreciation as a whole on the rental. And so just kind of going over that while everybody files in here. And then I forgot to write down who had the question last week, but it was on breaking. This is about depreciation, but there was a big question last week on residential versus commercial. Was it you, Grace? Yeah. And so I did see the 50% thing, and it looked like that applied to hotels and motels. The actual regulation I found said that 80% of the rental income has to come from a dwelling unit to be considered residential. And so you can unmute.
That might be completely correct. I just know that in our situation, like if it's over 50%, I think I just threw out 50% because it was over whatever. Like, I guess the point that I was making is you can't say we're going to depreciate this as residential and this is commercial.
Well, and that's where I couldn't quite exactly find on breaking down the properties as far as like property A, B, and C, if it has to be defined by legal title or if it's by economic unit. That's where I'm trying to find is what distincts Schedule E and listing things by property. In my brain, it's saying that it's by legal title is the way that you would separate each property, not by each unit. But I can't say that with 100% certainty. So in my mind, the way of applying the 80% rental would be, so if you got 3 units, 1 commercial and 2 residential, I would list the economic unit of the 2 residential as one and the commercial as another, because then you would depreciate the 2 residentials as 27
I didn't interpret it like that at all. I said this is the building, this is the building, and if you have so much percent of it is commercial and so much percent of the building is residential, that's where I got it, where it was coming from. So
so on that, in that case, it boils down to rent received.
Yeah.
And so it's not based on square footage or anything like that for the whole thing to be.
Okay, so it's based on rent received and not on square footage?
Correct.
Okay.
Yeah, if you want to look it up, I'll put the code section in there.
I I still think that we came out on the short end of that stick. I don't think that I don't know that we were able to take the residential depreciation. I think we still came out, we had to depreciate it as commercial.
I believe so.
But it's by rental receipt.
It's by rent receipt. Correct. Residential property. Yeah. So it's kind of, it's more or less you have a property and it's not, does it qualify as commercial? It kind of starts as commercial and then can you do it as residential rental is the way that it kind of looks. So I'm putting the code section on there so that you can look it up and determine for yourself. But it's 80% or more of gross rental income for the tax year is from dwelling units.
So for example, in this one, so I've got a couple of different units like this, but I've got the one where it's basically it's a 50-50. The ground floor is commercial, the upstairs is residential. The residential unit comes online first. Yeah.
So that's where that's where it gets a little bit of a predicament because it's gross rental income for the tax year.
So I think we did that. I think we realized that. And I think that's what we did is we started the depreciation as residential. But then what do you do? Then you switch it? Like if the downstairs comes online and you're getting more money, more rental income, you're getting, so if it's
on the commercial, I'm going to keep digging because it's coming on as a second time. It's coming in at a different period, which would change the nature of it, which also means you weren't doing it incorrectly to begin with. So it's not like it would be a 3115 or anything like that to where you'd have to
let's just
fix
say
the
for fun's
depreciation.
sake, though, let's say I started off depreciating it as a residential rental, that ground floor unit comes online, then do I have to go back and refigure the depreciation schedule for that?
I don't think you would because it was correct for that year.
The year that it started.
The year that it started, because it's based on gross receipts for the tax year.
So then,
and so that's where I got to find is because you could have a property that flip flops if the commercial one's vacant for a while. So this is really a can of worms.
Yeah, I don't like it.
No, I don't either.
So, I mean, would you just say, okay, well, it started off being residential and then that's the way it started off and then things change later? Too bad. Would you just keep it as that portion of it residential and then depreciate the lower half as retail?
As commercial, yeah, that's how I would do it.
Okay.
Yeah, that's how I would do it.
Just like that one coming at you.
Yeah. Okay. No, I love it. And so, well, because that's where if this happens to you, it's going to happen again to somebody else as well. And so as far as, I mean, if I was myself drawing it up is because the commercial portion wasn't even in service. So I would put the residential percentage into service as residential rental, depreciate it that way. And then once the commercial section comes online, then depreciate that amount under commercial and then keep them both running side by side. And so that would be because it would just be too big of a mess. There's no way you could flip flop each year because you could even have year 5, like the commercial side, is vacant for a year again. You know what I mean? And so that wouldn't make that now subject to 27.5. So then
you just opened up the other issue then is long-term vacant portions of a building. So if something's vacant for an entire year.
Well, as long as it's available for rent, you would still be depreciating.
What if it's under renovation?
Then technically you shouldn't be running depreciation on it if it's not available for rent.
So then you just stop the depreciation schedule.
For that year.
Part it up.
Yeah, part it up.
So you got 18 years of depreciation and then you stop it for a year and then you pick up at 18 years.
Technically, I don't. I mean, if something's under renovations for 6-8 months, I keep the depreciation running.
I do too.
Yeah. I don't know. There's also things by law and then there's things that we do as tax preparers. And so, unfortunately, on some things, I must say
That makes sense.
It might not be right, but yeah, I don't stop depreciation unless they stop renting it, and move into it. And so, or it times out. I mean, if something's vacant for more than a year, there's something wrong with it, as far as the client goes. So I'll really test them. If it's vacant for more than a year and they're still trying to take expenses on it, then I'm like, nah, like you're not trying to rent it. It should have rented by then.
Okay, in that vein then, so let's say they just stop renting it. So they've got a rental unit. It's been a rental unit for 10 years, and this would probably go with any commercial piece of equipment or property or whatever. You've used it for a certain amount of time. It's not fully depreciated. They just stop using it. They move their kid into it. It's not a rental unit anymore. They stop using it.
Yep.
They don't have any recapture then until they sell it, right?
Correct.
Okay. And that goes with everything, right?
Yes.
Then I don't get the falls below 50% business use thing.
On recapturing bonus depreciation?
Is that only for bonus?
Yeah, well, because I don't really use Section 179 on my rentals, so it falls for bonus or Section 179.
Okay. All right. That was probably an easy question that I should have known.
And and that's where I know they're transcribing this, but if it falls below 50% use, I don't go back and look at the depreciation schedule and recapture. Because, anything under 15 years or less, you get bonus depreciation on rentals. And so, but I haven't gone back. If they pull it out and make it a second home or a kid moves into it, I just, go through and stop it on the date that it stopped being a rental and cut it there. I do, however, though, one thing to make note of is you definitely want to print out a copy of the depreciation schedule for everything that was taken, because if they do sell it, that will come back into play. And so if something was a rental and then they stop renting it, definitely print out the depreciation schedule through that date and either, save it as a PDF in their file under some type of like permanent file for where for my clients in my document management, I keep a permanent file for, like final closing escrows, things of that nature, or depreciation schedules. And, I label it with a note that like, if property blah, blah, blah ever sells, use this. And so make sure you have some type of way to make sure that that's available in the future if they ever do sell, because then that depreciation would come in.
That's usually the year that they switch tax preparers.
Usually.
Yeah.
And have I ever heard of that coming back? One other side note, and then I'll hop right into the topic, though, is so before 1997 on Section 121 exclusion. So before that, buying and selling a home was basically like a like-kind exchange, and you had to rebuy. And all of the gain rolled into that new property that you bought. And so technically, if you use that prior to 1997, if that's the house you're selling now and using Section 121, you're not supposed to use the purchase price when you bought it. It's the purchase price minus all that gain you rolled over from pre-1997. Now, as far as all those records go, now I bought my dad out in 2002, so I've got some files that have the actual forms from pre-97. But that's one that they've probably changed tax preparers 100 times. I've never seen it brought up again. I mean, knock on wood. But that's another one of those issues. But something to keep in mind, though, is the IRS is updating from whatever tape decks they're using as computers. It may be something that they actually track in the future. I don't know if they can actually track it right now if they don't have like the paper copies in front of them. But I wouldn't be surprised in the future of taking a depreciation on a property.
Track depreciation.
I don't know if they can. And
I really don't think they can.
Yeah. And they don't, well, the problem too is with the IRS, they don't really look at year to year pretty much. Like I've only seen under audit, like unless they actually line all three tax returns up together, that's the only, year to the next year that they have. but that's issues for another day. So today we will hop into rental expenses. And so we'll just kind of go line by line, Schedule E, see what we got and see what kind of questions we have from there. Let me read the chat real quick. Depreciation. The amount they use for proceeds that you claim for asset recapture. So on that one, if they give an asset back, I don't really know. I'm answering Reva's question real quick. If they give away an asset, the sales price is zero, so there's no recapture. It would only be if you put something out of service and you keep it. And so that's where I usually always ask my clients if they threw it away or not. And it's like, yeah, they threw it away. Mixed use, residential, commercial, lower, 1 unit or 2 units. So Tiffany, that's one of the big discussions that we're having on that. And I'm going to gather more information because it looks like depreciation is based on the amount of rent received. But what if they come into play at different times? And so I'll have an answer for that next week as we're gathering more information. Steve concurred. Passive activity loss, PAL in the future. Yeah, the PAL they'd want to use in the future as well, but that should keep running on the 8582. So that one will keep carrying forward. Okay, on to expenses. So looking at Schedule E, advertising. That one's pretty easy. As far as advertising goes, either they're marketing it out, running ads, or online using different services. That one's not hard. Auto and travel. That's a fun one. I use standard mileage rate for just about anybody. Anybody here take actual expenses and depreciate like a new truck for a rental for a client? Oh, it's hard to get the business percentage up there to really do anything if they've only got 1 or 2 units. So I don't really waste my time grilling my clients on that. As far as, do I make my clients keep a record book for it? Not really, but it's basically going to the rental and getting supplies. So as far as, just I ask my client, how many times do you go to the rental? Do you check in on it? Do you drive by it once a month? Do you look at it? How far is it from their home? Yeah, I don't ask for a mileage log. The client's supposed to have a mileage log, but as far as which is supposed to be contemporaneous, which means they did it at the time of the event. But I haven't had an issue under audit just being like, okay, they went, once a month. As far as time frame goes, then or if it's a far away rental. So I do have ones that are in like Vegas, Idaho, things of that nature. So I make sure that they don't lie as far as I want something corresponding, like them getting gas in Vegas or something to that extent, to prove that they were actually there. So I may ask like a follow-up question, but it really just boils down to standard mileage rate. Be like, how many times did you go to the rental, and figure out what the round trip is, and kind of go from there. The only time that I did have one unit that had a big lot that they used a tractor on and everything. So I did depreciate about 60% of a tractor, as far as it was a big residential property, multiple acres, everything else. And so how about looking for new property? Do you add that to the expense or future basis? Searching for properties is really never deductible. Steve's question there. I don't know of an instance, and it's a big hot button as far as for real estate professionals and everything else. Searching for new properties, it doesn't go into basis. It doesn't really go anywhere. Anybody correct me if I'm wrong on that one? But as far as searching for new properties go, it doesn't really go anywhere. Sean.
I thought it was my understanding that if you were searching into new areas, you had to wait to actually purchase the property before you could claim it. Otherwise, it's considered a startup cost. It's considered part of a startup cost once you find and purchase a property in that area. Yeah.
Yeah.
But
so
not until you.
But not until you actually buy.
Yeah. So if you go, I fly to Hawaii and I look at some rentals and I live in New York, but I don't buy
And so
anything, then I can't
if
claim
they
any real estate.
buy, you're adding the cost of the trip to Hawaii uh to the purchase price.
Or if you buy a lot of stuff to a startup, but let's just say 10 years later, I buy something in Hawaii. At that point, I can realize the expense. So I've looked that one up in the code a couple times.
Yeah. So yeah. Okay. So you'd increase it. So you'd have to actually buy at that point in time.
Yeah, only if you purchase, because again, they consider it moving to a new market. They consider that a new business startup. They don't consider it an extension of your existing business, moving to new markets.
Okay. Got it. And as far as rentals go, Chris kind of added to the future basis. So yeah, so hunting costs, searching costs. So they'd actually have to pick one up. So I'd probably just make a note for the clients, either in their file or folder, or make sure that they track by area and everything else, if and when they do future purchase of property in that area. Also on that, from practice note, how now for most people, I guess I can say the way that I do it, as far as how do you accept, as we're covering expenses, how do you accept the expenses from your clients? Do most of the people here provide like an organizer sheet to their clients? Do you ask for it in Excel? How do you get the info from the clients for expenses on a rental?
I just ask them for the information in the Excel document.
Okay. Do you provide like a template or anything like that?
No, I only have two people that have significant rentals. So they've developed a spreadsheet that kind of works for them. And so it's easy enough for me to understand. But I feel like a template would be a great tool. It would just make the tax prep so much more smooth.
Most definitely. And that's where I've worked on. I've transferred. So I use Lacert, which in the organizer. So a lot of the times, for a lot of my rental clients, I don't send it out to everybody, but most of the time they'll come back and request it. Is that in the Lacert organizer, it'll give a list for each property with the prior year amounts on it. And so for most of my clients that have rentals, I'll email that over in a PDF. And then they either do it in Excel or fill out the actual PDF. And so that way, but either way, I provide either an Excel template or the numbers from the prior year to get it back. Does ProConnect? I don't know if ProConnect does that on the organizer side. And so in Lacert is if you print out the organizer, it'll go to PDF and it reports all the prior year amounts for each rental. And so report from property manager. Those are the nicest ones. If they can just give you the report from the property management side. I know they do run about, I think property management companies charge somewhere around 10%, but I do try to push my clients towards using a rental management company as far as it just keeps it nice and organized. I believe also Quicken makes a rental tracking software. And but if a client buys a new rental, I recommend that they, first off, we already talked about it, have a separate bank account, but also depending on the level of stuff that they're doing would be to get some type of side software to track it throughout the year so that they're not doing it. But I would recommend if you don't have something, you don't want to, I try to minimize the amount of time, like every client that has a rental, I don't want to go over with them 10 times on what's deductible, what's not deductible, this, that, and the other thing. So provide them with a template, tell them that you need totals. I don't like going through a stack of receipts for clients. I just tell them I want a summary. I want the total number of expenses. And then I go from there. Then if anything looks weird, like too high, repairs is coming in at like $25,000, be like, okay, we got to break that down. Also in the template that I do send over, it does state on there, and which we'll get into this in just a minute, but if any expense is over $2,500, then, we have to depreciate it. So there's operating expenses and then what has to be depreciated. So I do have a note on that. And I try to make sure that my clients kind of know bare bones of the rules in the beginning. I do have a template email that I send out if any client is curious about what is deductible, what isn't deductible, what they do need to track. So I have basically a pre-canned thing that I send out on that. And that's where I think pronto we're working on one too, as far as maybe a template or something you can send out to your clients to give them, because the more reading they can do, everything else they can do. I mean, every client that has a rental, I don't want to spend a half an hour going over what they need to do. It'd be like, here, read this, you can do it on your own. And that's really the time saver that'll be for you guys as well. For Linda, might have property managers, any additional costs like repairs. Yeah. Clients with rentals in other states with family and they manage the property. Do you allow trips to check on the property or just one a year? I allow trips to check on the property. I mean, I deduct those, but I make sure that, it's within reason. If they're going out there 10 times a year, I mean, it's pretty hard pressed unless there was a leak or damage or renovation or why are they going out there? You got to make it make sense. And so if the auto and travel is too high, it's something I'll question. If they come back with like $5,000 in travel costs, it's like, no. But did I have a client that went up to Idaho 8 times because of a rental? Yeah. And so they had all kinds of land issues, permit issues, all kinds of stuff that they were flying up there for. Did they rent a private jet to go there one time? Yes, they did. Did I write that off? No. So everything sounds cool and all, but IRS also has the reasonable rules. And so when it comes to travel, this is business as well. If you pay an exorbitant amount of money for something that's an ordinary expense, if you didn't have to pay an exorbitant amount of money, they're not going to allow it. They're going to break that back down to what a commercial flight would have cost. So unless you can prove something that they had to have that actual exorbitant expense, like flying private or flying first class or something like that to go check on a rental, you're going to be boiled back down to, just writing off the amount of a normal plane ticket. So I don't get overly, I hate the term aggressive for people that use that, but I don't go crazy on it. And so, but other than that, most rentals you'll find is just some mileage going to check on the rental or fix something or this or that. John?
Yeah, I was going to say one thing to keep in mind is that if someone's doing large renovations, travel isn't deductible. It's part of the renovation costs.
As part of the renovation cost, correct. And so, yeah. And so that'll go into there. So that's something to take note of as well, if it's available for rent or not at the time of the travel. But for the most part, you're going to be dealing with mileage, which is pretty standard issue. Should they keep a mileage log? Yes. Could it be as easy as a calendar or something like that? And they say, I went to the rental. Sure. That's perfect. And then as far as under audit goes, I've recreated them and haven't had an issue with it before, as long as it's not something that's too big. And so next item up, any other questions on auto and travel? Engineering and trying would have to be depreciated. That's part of the cost. If it's something that they're newly built commercial, yeah, that's all. That would be depreciated. Cleaning and maintenance is the next item up. That one's usually pretty straightforward. Commissions, that would be as if they pay a commission on property manager finding a new tenant, or if they give like friend or referral fees, something to that extent. Insurance, that one's easy to go. That one's easy to do. As far as the only issue that I really come across on insurance is if they have an umbrella policy. Has anybody else here run into that? A lot of times, so you'll have the homeowners on you'll have the normal homeowners on it. They might have a side policy because it is a rental. to cover this, that, for it actually being a rental in the tenants. But then also sometimes I'll add in if they have an umbrella policy that covers liability, things of that nature, but in totality of everything that they own. So at that point, you might have to do a little bit of extra digging, but I'll get a copy of the umbrella policy or look at it and take a percentage of it as far as for the umbrella goes, that if it covers something towards the rental. How do you handle life insurance purchased? Well, life insurance isn't deductible except for in C course, but you're talking about for the rental, like to pay off the mortgage or something?
Yeah, I've seen people buy life insurance policies relating to cover the illiquidity of the asset, particularly in states with inheritance tax.
I haven't come across that because we don't have inheritance tax in California. As far as, yeah, that would be, Steve said he's only deducted if it was required by the lender. That's a very solid point. Or is it a life insurance policy that like specifically states it has to be used to pay off that mortgage, or is it just something that the person will get the more money and would pay off that mortgage if they want to?
No, none of them would specifically say that it has to be used to pay off the mortgage.
Yeah, so if it doesn't specifically state, yeah, because then the person could go and use the money for something else. So you can't really say it's required for that rental. So I guess that would fall more under ordinary and necessary, that it's not really necessary. I mean, it's nice for whoever inherits the property. But I wouldn't, if it's not specifically for that or for like a hard money lender or specifically required for the rental, I don't deduct it. I don't see it being ordinary or necessary for the property itself. It's nice. Good.
I never did, just checking in to see if I noticed anything.
Oh, different. Yeah. I don't on that one. Just to handle a couple of other questions as they're coming in. Newly purchased house, lots closing, deduct those closing costs, or only asset house. So we'll talk about rental setup on another day under depreciation when we're setting it up. But closing costs go into, just real quick, closing costs go into purchase price, which as far as setting up the initial depreciation on a property of land versus building goes into there. Really got two options on it. There's no 80-20. You have to use the property tax statement or an appraisal. You got to get an official value for what you're going to be taking depreciation for the building. And there has to be a definable percentage that you can use. And it's either from the property tax statement or from an actual appraisal. Grace, something to add?
So I usually use the actual cost of the property minus the value of the land.
Yes, correct.
Okay.
But you got to get the value of the land.
Yeah, that you get from the assessor.
Correct. Or from an appraisal. You can use either one.
Oh, right. But
so a lot of the times I'll use an appraisal because
my experience is the assessor is going to give you cheaper land and more expense on the building, which is what
yeah. So interestingly enough, so it also depends on what state you're in for that, because that's where in California, land is completely skewed on the property tax statements. Sometimes the land on California here in Orange County in particular, they have land anywhere upwards to 60 to 70% of the value.
Okay.
Is land on the property tax statement. So that's where for most of my clients, I'll get an actual appraisal and either get it from the purchase. If they didn't do an actual appraisal, I'll have them pay the $400 to get one, just because it'll benefit them in the long run, because the property tax statements here are just absolutely terrible. So, but yeah, a lot of people out there, and I've seen it, stay away from that. You don't want to do that when you're breaking down land versus building. There's no flat percentage. There's no 80-20, 75-25, 60-30, or 60-40. There's no percentage like that to break down land versus building. You got to have tangible reason. And so I use software called TurboTax. And so, not TurboTax, tax tools. That does it. You can plug it in and it'll use the percentages for it. But which on setting up a rental, we're going to go through that on another session. And so, so we covered that, covered insurance. And so, as far as the only other thing that I wanted to cover until. Okay, so next up is legal or professional fees. That's where it's seen. So I break down Schedule E. So this is the next line item is legal and professional fees. I do break out a portion of the tax prep fees, so it's listed on the invoice. I charge per form. So as far as it goes, is I charge for the Schedule E, I charge for the 4562, charge for the 85, the passive activity loss limitations. So I add all that up and I take the portion of the fee that's for the rental. If it was a first year, I charge an extra $200. Yeah, Steve. So that's where I'll get into the next one on that. So I break it out and I put it on the legal and professional fees line. I don't take the whole amount. I don't take a percentage. I go back to my invoice because it's stated on there, and in an audit, I don't want to look like an idiot. So you do want to make sure that you do, break out your fees from the prior year tax prep and include it on the Schedule E. Here's another one is if they have an investment broker. And that's where this one might be a little bit of a gray area, but as far as I know that they charge the fee. So let's say you have a client that has a big portfolio, they're paying the 1% to their investment advisor. That 1% is based on the assets that they have with that advisor, not necessarily the rental property and everything else. I do have several clients though that we have, multiple conference calls between my client, me, and the investment advisor. And so I get a letter from the investment advisor that says, that gives me an amount of the annual fee that they charge the client that can be for rental advice because we're covering it and everything. So on the investment advisor fees, I will, on some people, break out a portion of that and put it under legal and professional as well. Anybody else here do that? Yeah. So, and to be honest, it was something I didn't do for a long time. I really never paid attention to it. And until I started getting into clients that had bigger rentals and had more involved investment professionals. And then I got a new client that was like, I had to ask them why their legal and professional fees were so high. And that's like, they were like, well, we're deducting a percentage of this based on what they say. And so on that one there, so I didn't do it for a long time, just never paid attention to it. And that's where, a lot of times if you're not doing something and the client doesn't know, then it just doesn't get deducted. And so I do include that in legal and professional. Management fees, that's an easy one. If they're using a rental company, they cover the management fees there. Mortgage interest paid to banks, got that there. Other interest. So on that one there, and this is one to just, if it's reported on a 1098, it goes under the mortgage interest paid to banks line. If it's not reported on a 1098, I put it on the other interest line. Or if they have a credit card specifically for a rental, if they pay any credit card interest on that, I'll put that on the rental schedule. Also on other interest as well, because they like to put a note on it. It depends if it was reported on 1098 or not, would be is if you're electing to treat, and I'm going to cover a whole section on elections for rentals, but quick note that if you use proceeds from a principal residence for a rental, there is an election that you can make to treat that debt as not secured by the principal residence, and therefore put it towards the rental and claim that rental claim that interest on the rental rather than on the personal. And so it's a note that you attach to the tax return to make the election to separate out that portion of the debt and the interest that corresponds to it to the rental. So that would be if like you take out a second on your principal for 200 grand and use that improvement for a rental, then we'll elect to not treat that as principal residence debt and deduct it on the Schedule E. So there is an election for that, and you have to attach it to the tax return, which is really handy because technically, especially since they got rid of home equity debt being deductible, if you pull money out on your primary residence and use it for rental, it wouldn't count anyway. And so you got to be careful of that. Next up, repairs. So I'll just do it quick. Repairs should be, little stuff. If it's under $2,500. So there is the election for the safe harbor. If it's under $2,500 per item, 10 grand total, or 2%. Is there a limit used for repairs? Steve says, so I use the repair regulations, which is under 2,500 per instance. And then you make the election and you attach a little note as far as what you're using it on, but you got to follow the rules on it on 2,500 per item, 10,000 in total, or 2% of the 2% of the 2% of the value of the building. And so you got to stay within the parameters. Now, as far as the 2,500 is per item. So I guess to your point, Steve, is if there's a bunch of little stuff, I don't count that towards the 2,500. So the 2,500 I apply to like a specific repair, as opposed to like a bunch of little stuff. I'll usually put that in supplies or kind of keep it separate. And then the 2,500 repair regulation is on identifiable.
So if you purchase a furnace for $2,500 and then you paid someone to install it for $1,200, if you wrote out, as long as you wrote out like 2 separate checks for that, you could.
No, that's where without getting too. Yes, Steve, I always attach the de minimis election. So, but it's a checkbox in the cert, so it kind of does it for us. In that note, though, is I believe air conditioners, heaters, there's certain things that are completely separated out from the repair regulations that aren't even included in it. So I believe heaters and ACs are one of those. So it's not even eligible for
the furnace because you don't have any choice, but you could separate out the labor cost and stuff.
No, because there's actual code that stipulates, I believe, on it that the labor to install the furnace has got to be included in with the purchase price of the furnace.
Well, then I'm going to jail.
If it's over a couple of bucks, but I don't know if anybody's going to go there. And that's where if you ask people about water heaters, there's 10 different 10 different answers. Do I put water heaters under replacements on the Schedule E? Yeah. Sometimes if they're like $400, water heaters are technically supposed to be depreciated. You'll see a lot of people argue between water heaters, air conditioners, furnaces. Is it 27 and a half year? Is it 15 year? Is it 5-year equipment? Is it an appliance? Anything attached, I'll keep it easy on that one. Water heaters and air conditioners are 27 and a half years. But that's just the easy way to go about it. And so the big one, better adaptation, restoration. There you go. And so when it comes to repairs, if you see a big amount, you'll want to get a breakdown from your client of exactly what was in there and be able to use the repair regulations, write stuff off. Supplies. So that's where too is I'll break things down into supplies. So it's not counted as a repair if they're going to like Home Depot, things like that. Little supplies here and there, buying tools. I'll let clients submit, not necessarily receipts, but if they're actually working on stuff for the rental for themselves and they buy some tools and supplies and such, I let that go through. Taxes is easy. That's property tax, and then utilities, easy one. as far as what's there. As far as other just general expenses for rentals, I break out, and this is where. Can you elaborate more on that? I know a lot of people, I don't do home office for any of my clients because they're not really doing enough for it, or we're already claiming home office for business purposes. And so I don't, I remember, I think it was a couple of years ago, we did a big one in Andrea's answers about, home office for rentals. And the conclusion there was, to take a home office expense if you're using it. The problem that you would run into is the amount of time spent using the home office, and if it's exclusively used for the rental property. So that's where, if there's any other use for that area or anything to that extent. And so on that one there. So a lot of people do take the home office for rental expenses there. And then plumbing and electrical, I separate out. Yes, you can claim miles if you don't claim home office. And so because technically you can still have principal place of your record keeping, everything else for the rental is at home without taking the home office deduction. Long-term is passive. Where would home office come in? Yeah, so that's where it boils down to if it qualifies as a trade or business, which, like I said, we only have an hour, so it's tough. So I'm going to cover in a whole section as far as passive activity rules, QBI deduction, trade or business, which also 1099 is going to fall into that. Are you required to actually 1099 your gardener? One asked before on there on if I, take each one of my clients and file a 1099 for myself. As far as the fee goes, if it was over $600 for the rental, I don't. But under in a separate topic, we'll go over the 1099 rules for rentals because they are very confusing. I'll be honest on that one. Probably a lot of people here that I have clients that have rentals that should be issuing 1099s that are not. It's a hard one to enforce. It's a hard one to make your clients do it. As far as, and then we'll go over some ways to manage your clients and if they should be 1099ing or not. And so I do have a couple of clients that do issue 1099s for the rentals. They have several rentals. So we make sure that everything is in order with the amount of them. General rule of thumb, if I'm taking the QBI deduction though, for a client, I do make sure that they are filing their 1099s because from the QBI deduction, you're saying that it's a trade or business. And so therefore do the 1099s. But there's a lot of confusion around that one, so we'll cover it in more detail. And so we're already at the 10:50 mark.
Under
that goes by quick.
Oh, under other expenses.
Yes.
Also, that's where you put wages. Like if you have an employee, like if you have enough rental units where you're hiring someone hourly.
Yes. Like if you, wages would go, well, it goes technically as another expense, but you would label it under wages and salaries. Right.
And then the taxes and withholding and everything also goes on that line too. It all goes in one line.
Payroll. Yeah. Payroll tax would be a set, not on the same. I take two separate deductions. So one line item is wages and salaries. Second line item is payroll taxes. So I put them as two separate categories. I do have one client that has a couple of apartment buildings. So they actually have an employee that's a maintenance guy that takes care of all of them. And so any other questions quick question on expenses as we're wrapping up here?
One related question on that election. If you have a home mortgage or a HELOC, and taking the election so you can have the interest over on Schedule E. Mm-hmm. Can you use that same rationale for like a business owner?
You can.
You can?
You can.
Even if sub S partnership? Either way?
Sub S, it would be so on that one, it depends on that's a big can of worms. Do I have clients that I have elected to treat home mortgage debt is not secured by the residence and that it was used for investment interest, yes. That it's been used for in a trade or business, yes. And so, but when it comes into if it's a passive business or not, you're talking between investment expense. Is it an employee expense? Is it?
Yeah, the one I have in mind is a father and son outfit that builds houses, and they're building a house, and rather than get a construction loan, they're doing a HELOC.
So, and then they're doing it. So see, that's really what they're doing there is it's capital contributed.
Yeah,
to
that's
the
what I told them.
business as far as what do you got, Sean?
If they're borrowing under their personal name and then they write a loan to the S Corp, that's actually the right way to do it. And then they claim it a loan to the S Corp.
Interest. Then it's going to be interest income to the owner, so there's no sense in doing that.
Well, no, because then they'll also pay the interest offset when they pay the mortgage.
Yeah, so it'd be investment interest. So it'd basically offset.
But if they borrow it under their name and then draft a second loan to the S Corp, that's actually the way the IRS wants to see the S Corp loans from an owner go.
Yeah, so it'd be taking it on there because that's where, as far as I don't think on it, because you're dealing with entities. So the election pertains more to personal as far as it kind of stops there. So you wouldn't be able to deduct that interest like inside of the S Corp. Because then you got your own rules. So as far as the election to treat debt, not to make the election for the debt not to be secured by the principal residence, then you're saying that it's secured by something else that corresponds on the 1040 return, either investment interest, Schedule C, something of that nature, or loaning it to the S Corp, then it would be investment interest. So you wouldn't really be able to have that interest deduction inside of the entity itself.
Yeah, because then you'd also have the problem of 1099 INT.
Yeah. Well, you can't do it.
Okay.
Yeah, you're on the same page with that.
I had my hopes up when you said about that election. So, oh well.
Well,
yeah.
I'm sorry. Can you back up? Why, if he really has a loan document drafted and he's really paying interest, the S Corp should be able to take the deduction because they.
Well, yeah, they would take the deduction on that. I'm talking about the deduction for the mortgage interest paid. You wouldn't be able to take it. So the way that Sean says it is how you get the deduction so that it offsets is you create the loan between the person and the S Corp. The S Corp's paying the interest to the person, so the S Corp's taking the deduction. Then the interest hits the personal return, and then you elected it to be investment interest, so then it offsets.
Okay, so then you make the election on the personal return for investment interest.
Correct.
Okay, gotcha.
Bingo.
Good info. Thanks much.
So, it's money. Correct. And then Steve's on the same page too. Okay, good session today, everybody. And so we'll dig more in. I'm going to talk to Imelda. So for next week, though, I think setting up a rental and depreciation would be a good one to do.
So setting up a rental and depreciation?
Yeah, rental setup and depreciation.
Okay. Do you want me to go over the list of what Andy thought that he wanted us to cover? Do you just want to go?
Oh, well, yeah. What is Andy? What's Andy looking for?
So here, let me give you some. I think that what we're covering is fine. So we have passive active loss limitations and how to avoid them. And then how to get tax-free rental income, and then unreimbursed partnership expenses, QBI aggregation election for rental property activities, and then the 1031 exchange.
Okay.
I'm thinking, I guess we can just kind of feel it, like see what direction we're going. And then if we cover any of those topics, then I'll just go ahead and put it on the list that we covered it.
Okay. So for next week, then I would say, well, then, so for next week, let's do QBI and 1099s. And then I can We can do QBI, but I also want to go over 1099s more in depth because they do apply to QBI as well.
Okay, so do you want to just go ahead and finish depreciation and setting up a rental?
I can go over it quickly.
Okay, how about
I think people want a lot of. I just didn't want to double up if anybody else is already doing that.
No, nobody's doing that part. So
Okay.
there's no, so you're good. So we do depreciation and setting up rentals. And then do you want to include QBI and the 1099s? Just
Yeah, because it's going on. You want to make sure you put your client in the proper course from the get-go.
Okay, so then I'll go ahead and note all those things on there for tomorrow.
Perfect.
For next week's session. Okay,
All right.
cool.
That way everybody gets a little of everything.
Okay.
Okay. All right. And Grace, I will have more information for you too on your property. So I'm intrigued on this. We're going to work on it.
Thank you.
Okay. All right, everybody. Have a wonderful Monday. Thank you for tuning in today to Mastery
Thank you.
Mondays.
Bye-bye.
Thank you on my behalf of myself and Pronto Tax School. Have a great day.
You too. Bye.
Thank you for joining us. I'm Imelda. Join us next week as we continue to share mini audio clips of Schedule E tax prep process. If you are interested in listening to the full process and want to be part of our Dream Team community, please visit prontotaxschool.com or email us to support@prontotaxschool.com. Being part of the Dream Team membership comes with getting expert support, top-rated training programs, and weekly video live events. We look forward to having you on board.